I think the uncertainties is very high, and I would point out two things. One is, well, there is much more uncertainty than the data, the statements, the policy decisions, and the political environment, and especially the tariff war is what is creating this extremely elevated uncertainty. So it's not only about the data. Much of the data we see in the financial markets instantaneously, but in terms of the economic data, of course, it comes only with a delay. So the source of the vulnerability are the political decisions, and then they get reflected into financial markets. And that would be one of the areas I would certainly very carefully monitor. Are the movements, dislocating some fundamentals or not?
Are you seeing
especially
that at this point?
Not that far. So far it seems to be relatively orderly, and for instance, if one takes a look at the spillovers onto Europe, we've seen that the financial markets do work more or less fine. We haven't seen spreads exploding or something along those lines. But it is certainly one issue that needs to be monitored. In terms, however, of the macro scenarios, this uncertainty is extremely elevated also in the sense that given the possible outcomes, there are multiple scenarios and their probabilities are very similar with the baseline scenario. So with this uncertainty, it's very easy to jump from one scenario to another scenario, and the risk of various nonlinearities is very high. So it is certainly very vulnerable situation for the global economy, and even with still some revision downwards for the forecast also by the IMF, I would say they are on the optimistic side, and the risk of recession, of course, is non-trivial.
How much more complicated does it make your job on the ECB Governing Council then to decide on the further trajectory of interest rates?
It very clearly means that we will continue to take decisions from meeting to meeting because of this very poor visibility, but also the importance of political decisions. I think with all this uncertainty and vulnerability, this is also the time of opportunities for Europe. It's a time for Europe really to grasp all the aspects of being economic superpower and becoming really fully fledged political and geopolitical superpower. And that requires doing all those decisions that in the past were not carried out fully. After the 2008 and 9 global financial crisis, lots was done in the infrastructure and in the institutional setup of both of the euro area but the European Union as such. But many things have not been finished yet. We still do not have capital markets that would be as a single capital market. Single market in services is not there yet. We have a monetary union, but we do not have a fiscal union yet. So this requires political will, political guts to make those decisions and strengthen the European economy and assert its place in a global world.
But you seem to be implying, you at the ECB, given that you've cut 7 times the cycle, you've done everything you can to prop up the economy, to give them the best conditions possible. Now it's over to the national governments, now it's over to the companies to live with this new environment that we have to deal with?
We've done everything to fulfill our mandate to ensure 2% inflation medium term. Okay? And we are very close to it. And I would say that we are within the grasp of saying that that episode is done. We've reached the target. And if one takes a look at the dynamics of inflation over the past half of the year, we've already been below 2%. Now we're lingering somewhat above 2%. So we are in the neighborhood of our target, and it has allowed us to cut the rates. But of course, monetary policy is only one part of the policy mix, and it is extremely important, in my view, to do all the other things. To do all those structural things that in the past have not been completed, starting with banking union and capital markets union and other structural policies to strengthen productivity growth in the European economy. If that does not happen, then of course there is always the risk. If crisis comes, then the monetary policy is pushed to be the only game in town, which is not sustainable.
Absolutely. There are a number of factors that give the ECB some breathing room. It's the strong euro, of course. It is, of course, imports from China, weaker energy prices, weaker commodity prices overall. Does that mean there is a bias to cut further given this uncertain environment?
I would not comment on that, given that every day brings news and the shocks most of the time are negative. So we'll see. But if one takes a look at the growth outlook, then of course most of the risks are on the downside. Weaker economy, of course, would also mean somewhat weaker labor market, which we already are seeing in the data. We see that vacancies are slowing down. We see that wage growth is slowing down, very much in line with our earlier forecast. So, so far so good in terms of dealing with inflation, but we'll see, of course, what the uncertainty brings for the economy. And then, of course, what are those implications for inflation dynamics going forward. But monetary policy cannot and should not be the only game in town. It's the strength of institutions overall within the Union. It's the strength of structural policies. And of course also defense. And defense is one of the areas where Europe can very strongly benefit, both in supporting confidence, because of course this ongoing war in Ukraine is negatively affecting both consumption and investment activity through lower confidence. But it can also boost the industry in the European economies because we need more defense. And Europe has finally woken up to the challenges, and the investment for defense is picking up quite strongly, and the largest changes we're going to see most likely in Germany, which is giving up its black zero policy, will invest hopefully more in its infrastructure, also in its defense, and we'll see what the new government does.
But that could be highly inflationary. Are you concerned about that?
That is certainly one of the issues, but it's likely to come only somewhat later in the game, maybe next year. But that is one of the reasons also why these structural improvements are very important, because the stronger are going to be the structural improvements, the more of this will go into the output and the less into inflation. So this is certainly one of the issues to monitor for 2026.
Can I ask you about the strength of the euro that we're seeing? Of course, it is a sign of the euro being a safe haven, given the loss of trust in the US dollar. It's also a sign, of course, of the relative competitiveness. But it's bad for the export sector, even though on the other side does give you some breathing room in terms of potentially further easing. Is it too strong at this point, you think?
We are not targeting a specific exchange rate. But of course, exchange rate developments do affect our decisions, especially if those movements are large. We've seen over the past couple of months euro strengthening nearly by 10%. So effectively, 10% tariff and 10% strengthening is 20%. So it is an important aspect of competitiveness. But if we take a look at the historical background, euro at 1.15 against US dollar is nothing that we haven't seen before. We've seen multiple swings in this area, and we've seen much more volatility. We've seen euro going up to close to 1.5. Okay, would that be good for the European economy at this moment? Of course not. Okay, so we'll see how this affects the economy. It improves some of the inflationary outlook, but it may weigh down on the exports and add to this uncertainty issue.
And a final question to you. Can I ask you, are you comfortable with what the market is pricing in right now, given the high level of uncertainty that you're seeing? 2 more cuts this year. Does that sound about right?
We'll see. We'll see where the economy is and where the politicians do take us. Because, of course, the highest uncertainty is in terms of policymaker decisions. And of course, also what will happen with the financial market volatility. In the macro data, we will see all these things with some delay. Financial markets are reacting immediately. The possible 2 cuts this year, it is within the scope of the baseline scenario, I would say. Where we will go, we'll see where the data takes us. So from meeting to meeting, with an open mind, steady hand, and trying to ensure that we are at 2% over the medium term.